Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, so let's start. It's getting towards the end of the semester. Thank you for still bearing with me. We still have a very exciting program ahead today with a few topics to cover. All right, so that's where we started or left off from last week, talking about international banking. And we went through a whole bunch of pretty boring definitions for the different organizational forms that international banks could take if they want to operate in foreign markets, right? So for all of those, you need to understand the bottom line being that they differ in terms of whether or not they can make loans and accept deposits from foreign offshore clients, whether they're subject to local or foreign financial regulations, and whether or not they are the same entity or separate legal entities from the rest of their parents. And obviously, they also differ in terms of their setup costs. So these differences you have to know, right? So a correspondent bank, if we recall, a correspondent bank is basically just a partnership with a foreign bank in a foreign market. You do not have to set up physical presence in the foreign market, right? So it becomes very easy for you to offer some of a seamless service to your multinational clients or your retail clients. However, because there isn't a physical location with your own personnel in the foreign market, the services offered by a correspondent bank is very limited. And then we go the next level of effort and resources spent by the bank to set up a representative office. A representative office is one where you do have staff members from your own bank sitting there. However, they're different from all the rest of the other, say, a foreign branch or subsidiary or affiliate in terms of they are not the typical providers of banking services. They're more for an informational role, right? So they are more as an advisory for you, right? So they offer information and economic research about the local market if their multinational clients wants to enter into a foreign market. Or, as we see, central banks can also have representative offices in other countries. And so those are to establish and collect information about the local market and send it back to their home offices, right? So this differs in terms of a representative office that is more of an advisory rather than a typical bank as you would think. And then we go into foreign branches. Now we have to actually send people and establish an office in the foreign country, right? So it's even more involved. In this case, you're able to take deposits and you're able to make loans to foreigners. So that's one step up. The key difference here between a foreign branch versus a subsidiary branch is in terms of regulations. For a foreign branch, in most cases, it is subject to both the local law as well as the host country law, right? So if you are a foreign branch of Commonwealth Bank, then you're subject to the banking laws in Australia as well as the banking law in the foreign country that you choose to operate in. However, here, for the US banks, if you operate a foreign branch elsewhere, you do not have to have Federal Reserve requirements. You don't have to hold deposits and reserves up to the American standards, and you do not have to offer FDIC insured deposits. So there is a little bit of leeway in that case, but other than that, most of the foreign branches, they are subject to both the requirements, the regulatory requirements of the local bank as well as the local country as well as the host country. How do I get out of this? Okay. Okay, so this one for branch, okay. All right, so foreign branch here, subject to both local plus host laws. All right, and next, it is a subsidiary bank. A subsidiary bank is an operational form where, for example, Commonwealth Bank may establish an actual office in Singapore, and they actually incorporate that organizational form. And that office is an independent legal entity that is separate from its parent bank, right? So in this case, it's separate from the parent bank. So now we start to see the separation here. And then we also see an affiliate bank, which is similar, except that it could be only partially owned by the company or wholly owned. It doesn't, so that differs in terms of ownership structure from the parent bank. And then we have an EDGE Act bank here that I did not choose to talk about because they're mainly a US phenomenon. Basically, they are US banks that can establish offices within the US to take offshore businesses. So those are not something that we are concerned about in this course. And then we talk about offshore banking center. So these are really the most free in terms of regulations among all of these different organizational forms. And they are the ones that are able to do the most in terms of banking services, with the only restriction that all of their loans and their deposit taking can be only offered to non-residents of the parent bank. So in this case, if you are a US bank that established an international offshore center, then you cannot legally interact with US residents, right? So these are all for the offshore market, and they are basically the least stringent. In legal requirement. All right, because most of the time, they also face very low or zero taxes. Okay, so often the time, they face low or zero taxes on their deposits. Moderate to light regulation. Moderate to light regulations, and also they're able to engage in a lot of offshore transactions that can be anonymous. So you have a lot of secrecy around them. That's why you see, sorry about the flicking back and forth. So that's why you see with all the scandal with the Panama report, right? That was conducted, a lot of transactions, financial transactions that are conducted in offshore banking centers where the owners of those transactions are not publicly available until the Panama report came out. So from all of this, I think the key point is also the bottom line that you should take away is that for banks, again, they're conducting business for us as an intermediary for gain, right? They are trying to make a profit. Now, if they're subject to regulations, what does that do to banks' profit? Lowering their profit because it increases the transaction cost, right? Because if you have to provide insurance for the deposits, if you have to keep money or capital as reserves to make sure that you have enough liquidity, this means that you do not have as much money to make profits, to lend to other people, right? So that decreases your profit. It increases your cost. Because how do the FDIC, the Federal Deposit Insurance Corporation in the US or in other countries, how are they able to offer you insurance in deposits? It comes from the fees that are paid by all the member banks, right? So if an organization does not have to pay a fee to the FDIC or to any country's insurance agency, then their cost of funding goes down. And they have more funds to invest in profit-generating projects, right? So that's good for them. And so in this case, that's how a lot of these international foreign presence gets generated over time. As banks realize that if they go overseas, it's almost as if they're doing regulation arbitrage. We're talking about arbitrages in this course, right? And in a lot of finance courses. They realize that regulations are not really taking care of their foreign presence. And so they're taking advantage of that to try to lower their cost, offer their business to corporations at a slightly better rate than on the national market, but still get more profit as a result, right? So that's how this is really useful. So in this case, which one of these organizational forms do you think would be the most profit-making? Offshore banking centers, definitely, right? But given that we know this exists, and given we know that banks are engaged in regulation arbitrage, what do you think would be the response? The rational response? From like governments, we have a lot of international organizations that look after banking, such as the Bank of International Settlement, the BIS, the IMF, the World Bank. So for all of them, they realize that banks are trying to take advantage of this sort of loophole in terms of coverage of regulations for foreign banks and offshore banking centers. And so they are starting to step in to try to regulate these international presence. But it's a very long process, right? Because for regulation of international banks across the world, you have to have agreements from different countries. And as we know, it's very difficult to come up with agreements when it involves more parties. Remember our game that we did before the mid-semester? We know what is the best outcome, yet the incentive to deviate is so high, right? So it is very difficult, but international agencies are realizing this, and there are potential problems with this unregulated market that we might talk about a bit more. But at this moment, this is what this landscape looked like at the time, all right? But more and more people are talking about regulating this market to cover up the loopholes. Questions? Very good. All right, so what type of thought process does a bank think about when it decides to go to operate in an international market? So as we saw, there are a lot of organizational forms that they can they can choose. So let's look more closely into a bank's decision when it decides on the operational form in a foreign market by looking at just the branches and subsidiaries, because these are the two most important types of how banks go foreign, right? So based on this paper that's published in the Journal of Banking and Finance, but it's first of all a World Bank initiative by Cerruti and his co-authors, then they found the significant factors that affect banks are what's going to happen on the slide. But before we go on to the slide, can you suggest a few things that we have to think about if we are the bank managers, whether we should choose between a branch or a subsidiary? what might you think about? So here, let's be a bit more clear. When we have a branch, it's versus a subsidiary. A branch is still part of the parent, right? Whereas a subsidiary is its own legal entity. And if we set up a branch, then it takes up much less effort than if you're setting up subsidiary. Because if you set up subsidiary, it is its own proper bank. You have to invest more infrastructure. You have to invest more human resources into it. So it takes up a lot more effort. So given what we know about the difference between the branch and a subsidiary, what would you think about as a bank CEO if you want to go foreign? Okay, we're going to think about the revenue that we might take in, yes? Right.
So if there's a big tax gain based on the scale of the revenue, I would go for a subsidiary.
Okay, so you're talking about taxes in a way that's slightly different from what I'm going to show on the slides, where we're going to talk about whether there's more tax benefits of the local country for a local corporation, because a subsidiary is treated as a local corporation, right? So yes, I agree with that part. Yep. Yes. How you are going to look at the cost?
Yeah.
Yes.
So, how easy it is for funds repatriation?
Yep. So how easy it is to deploy the whole business, transaction cost, and everything. Yeah, repatriating my profits is very important, because for any business, if you want to go foreign, what do you want? You don't want to just, well, for nonprofit organizations, you don't care about profits. But we're talking about for-profit corporations, so we all care about profit repatriation, right? So that is very important.
Some countries are more patriotic, like they would like to patronize local companies that are, so for example, in Australia, you want to patronize, for example, an Australian company.
You're right.
What's the
patriotism?
What's
right.
the perception about foreign companies' influence on the country?
Definitely. And you want to think about, as we talked about Starbucks, right? If you want to expand into a foreign country, how are the foreign nationals going to view your business? Are they going to be openly accepting of your business, or are they going to have what we call a home bias, a patriotism, or an inclination to deal with their home, domestic companies, right? So we have to consider all of this. If we incorporate a subsidiary, then it's treated more as a local company rather than a foreign branch, which is the case of Bank of Sydney, right? They even changed their name to reflect more of a domestic character. So definitely, those are all of the things and the main ideas that we want to capture here, right? The costs and the benefits. Okay, so basically we want to consider the costs versus the benefits. So if we are thinking about the costs, we have to think about the home country regulations on overseas operations. As we talked about, a lot of countries have pretty loose regulations on foreign operations, and so this could become a good proponent for having a branch rather than a subsidiary, because once you are incorporated as a subsidiary, as a local company, then you are subject to home country regulations, right? Yes? Right.
The same goes to Germany. A German bank come into Vietnam, if they break the law of Germany, even though they set up a foreign branch in Vietnam, bank officials will be charged based on German law. So actually, the home country regulation is actually also it applies to the overseas operations in European Union and America.
So, okay, so the idea here is that basically I think the idea here is there is a variation in terms of how countries regulate their own businesses, right? So this goes back to the last point on the last slide. Different countries would have different regulations over international banking activities. So in what you said, you talked about Germany and the US and saying that their foreign operations would be subject to their domestic.
Cannot bribe the local officials to win auctions, even if this is a common norm in the foreign market.
Not on the table.
But they really try not to.
I understand. I understand. Yes. So the idea is that here, whether or not your own country's customs, so if you're a US bank and you're not allowed to do something in the US, are you going to be able to do it in a different country? The question is twofold. However, if you are actually going to operate in a foreign soil, you are subject to a little less, right, if you are a branch, because you don't have to be subject to some of the regulations in the US. That is that a local bank. Yes.
Is it for branch or for subsidiary?
Pardon?
Is it for branches or for subsidiary?
If you are a branch, then you are subject to the home country's law as well as the host country's law. But sometimes you can get some discount in terms of the law that you have to be subject to. However, if you are a subsidiary, then it could be the case that you're not subject to your home country's law, but you are subject to the host country's law. And so what we're talking about in the other slide, when I was talking about that, I was referring to right, home countries' regulations on overseas operations as well as host countries' regulations on foreign operations. It really depends. There could be gaps that you can arbitrage on, right? So it's all about cost and control. You have to do a really good job at understanding the local laws and your home country's laws.
So I guess regulations is not necessarily just law. You also have, it means that you need to comply the law, but you don't need to comply regulations, because regulation is not necessarily law.
I treat law and regulations in pretty much the same way, because for banks in particular, if you actually violate a regulation, it's usually really bad for you. It's just as bad as if you violate the law, right? So, because banks are so important, they are basically the intermediary of capital flow between the lender and the borrower. It's the most important part of the engine that pushes all the economic activities going on. So actually the regulations are really important for banks. So that really matters. So in this case, we're talking about both home country regulations as well as host country regulations. Right? And then we are going to talk about whether or not there are entry restrictions as well as taxes that Jim talked about in host countries. But then I'm going to talk about something else in the point below as well. So there could be tax benefits for locally incorporated companies, and the bank's desired degree of penetration in the host market. So which one do you think allows the bank to spread more in a host country? Subsidiary or branch? Subsidiary, definitely, right? So if you are interested in large and probably mostly retail market share, then you are going to go for a subsidiary. And you're going to look for the bank's past expansion history. Was it successful as a branch? Was it successful as a subsidiary? Was it successful as a branch? And then if that success tells it that, hey, I can expand my market more, then I can go in with a subsidiary, right? So it's about more of expanding with care. And this is not just for banks, this is for any business. It goes back to the story about Starbucks' first expansion in Australia as well. Other than that, Australians love their home brewed coffee. Starbucks also expanded without care, well, without too much care in their first expansion. And so that's why it became, there's too many of Starbucks available at the same time. It does not became like something that everybody wants to go after. And what kind of risks the banks are going to face in the host markets? So this goes back to a lot of the costs that also Walter talked about, political risks, and also home bias risks. How likely are your home or are your host country's nationals going to embrace you? Branches are found to be more common when there are high corporate taxes, and that's high corporate taxes back at home, right? Because branches are still legally part of the parent, and so if there is high home tax, then you can sort of shift profits made from one center to loss-making parts of the entity. And on net, that's going to reduce your corporate tax back at home. And if you're going to target for smaller and non-retail foreign operations, which is similar to this point, right? These 2 points are similar. Then you're going to go for branches. And also, when there's a high risk of government intervention and major political events, then you're going to choose more of a branch. Why is that the case? If we are expecting that the country that we're going to operate in is going to be disrupted by, say, war, by political uncertainty, by anything that we're not certain about, we might want to operate a branch. Why is that the case? Right, because we don't have capital in that country, right? First of all, remember what we talked about. If you are a locally incorporated subsidiary, then you're subject to the local banking law, right? And then you're subject to capital reserve requirements, and you're also subject to local insurance schemes. So you have to pay more fee, and you have to have more capital reserves in that bank. And also you have bigger operations of your own fixed cost, right? If there are any political upheavals and you have to cut your losses, the loss associated with a branch is much less than the loss associated with a subsidiary, right? All right, very good. So these are some of the considerations in terms of the cost and benefit analysis for a bank, which is very similar also for any kind of investment that we're going to be talking about in topic 10 today. Very good. Okay, so we have talked about international banks, what they do, and then we talk about more of the market that international banking takes place, which is basically the euro currency market. Okay, so the euro currency market is the money market for deposits and loans denominated in currencies that are not the currency of the country that the bank operates in. So, for example, euro dollars are US dollar denominated bank deposits in banks located abroad. So, to notice here, as in most of our references in this course, if we're talking about euro deposits, euro notes, euro anything, it does not mean that it has to be located in Europe. the nomenclature only started because the financial center was located in London in the first place, right, before the World Wars. And then the names caught on and stayed as a historical fact. So how did the euro currency market get started in the first place? Well, it started in post-war period. So basically in about 1948. Anyone know? The US actually signed a 12 billion, what they call the Marshall Plan. In terms of economic assistance to rebuild Western Europe in the aftermath of the World War II. Okay, so that created a significant flow of US dollars to London. That created a lot of demand for US dollar-based deposits for London banks as well as other European banks. And that created the euro currency market to deposit the US dollar not in US, but in a country that's different from US, right? So that's what euro dollar talks about. And then it slowly caught on during the 1970s as a result of US banks as well as international banks trying to get away from the regulations in the banking sector. So it grew more in 1970s. As banks tries to right? We talked about how regulations are going to increase your cost and decrease your profits, your revenue, so that's why banks don't like that. And what they found is that engaging in this euro currency market, they are not subject to their home country's regulations, and they're not really subject to any regulations per se. So they're able to offer rates that are better than their home market, and they're able to get rates that are better than the home market, right? So it's a win-win situation really for both the lender and the borrower. So better rates for lender and borrower. Banks are happy, they're getting more money. Companies are happy, they don't have to pay as much in terms of their borrowing cost. And so that's how the euro currency market really flourished. So right now, euro dollars, whether they are deposited in Singapore, Europe, London, or Australia, they're still referred to as euro dollars. And then if we're talking about euro yen, then they are yen-denominated time deposits in banks located outside of Japan, the country that issues the currency. And given all of those history, it is still the case that a third of the euro currency market is still located in London, right? So of the market still in London. And so that goes to the next point of what we are going to talk about. Most euro currency transactions are interbank transactions in the amount of $1 million and up. So they are really large cap transactions. And because we're talking about loans comes with interest rates, then we have to have reference interest rates. And the reference interest rates that are most commonly used in the euro currency market are the LIBOR, the London Interbank Offered Rate, or the PBOR and the SIBOR. The Paris Interbank Offered Rate and Singapore Interbank Offered Rate. And then because of euro's strength, we are now having Euribor, which is the interbank time deposits for euro that are offered by one prime bank to another. And because of the large transactions here, and because of the predominantly unsecured nature of this euro currency market, so euro currencies are predominantly unsecured. What kind of people or what kind of institutions or corporations do you think can borrow on this market? In other words, these loans are not backed by collaterals or any kind of requirements that are typically required in a bank loan that's issued in a national market. So what kind of corporations do you think can go on to these kind of markets? Pardon? Right, so corporations with investment grade and above. So basically, we're talking about really large corporations with really good status and very good credit ratings are the ones who come on this market, right? So we're talking about Apples, we're talking about IBMs, we're talking about, the big companies that when they take the loan, they're not going to take it, default, and run away, right? That's why, who do you think is the most creditworthy person in this room right now? Me, right? Because I'm not going to, if you lend money to me, if any of you in this room lend money to me, you know that I'm not, for amounts that are, no, for any amount really. For any amount, I'm not going to take your money and run away, right? Because I care very much about my career. That's why I made the switch from banking into academics. So I have proven that I don't care as much about money. And I have my job here that I want to continue, right? So that goes in the same idea, along the same vein as the euro currency market. The borrowers on this market has to be really big corporations with very good credit status so that they're not going to run away from their loans. Very good. So if any of you have any spare money, tell me after class. Okay. So as promised, we're going to talk about the London Interbank Offered Rate. So you might have heard about this quite a lot. It's not just one rate, right? So it is a rate, an average rate of the borrowing cost of amongst 11 or 16 really major banks. So we're talking about the Royal Bank of Scotland, Barclays, Bank of America, Citibank, and all of those big banks. And what kind of rates that they are offering on different currencies and different maturities. So it's usually on 5 currencies, the dollar, the pound, the euro, Japanese yen, and so on, and 7 different maturities. So there are basically 35 possible combinations of LIBOR that you can quote. For different currencies and maturities. Okay, and they act as the reference rate, the reference interest rate for instruments that are issued on the euro currency market. So that means it's more of a floating rate. Because every single day, a survey is going to be conducted among the bankers of the 11 or 16 major banks in the world, and their interest rates are being quoted, taken average of to be as the London Interbank Offered Rate. And then we also have the Euro Interbank Offered Rate that's becoming more and more popular. Okay, what are some of the different instruments? You have to know what they are in terms of the basic ideas, but they're pretty much just variations on the maturity, on what kind of denominations they are, and so on. So in this case, Euro credits are short-term and medium-term loans of Euro currency. The loans are denominated in currencies other than the home currency of the Euro bank. So the loans are often too large for one bank to underwrite, so a number of banks would form a syndicate to share the risk of the loan. So that also shares the credit risk of the loan. Plus liquidity risk. All right, Euro credits, they feature an adjustable rate. The base rate is the LIBOR. So these Euro credits are usually given to really good quality corporations. And then we have Euro notes, which are short-term notes underwritten by a group of international investment banks, again, a syndicate, and they're typically 3 to 6 months. And then we have Euro commercial paper, and these are short-term promissory notes issued by corporations and banks. Maturity varies from 1 month to 6 months. They're typically US dollar denominated, and they're often lower quality than the US commercial paper, because if they are able to get it on the US market, they would. But they are not able to, so they go into the Euro currency market, and so the yields have to be higher. In other words, they have to be trading at a discount from the face value of the Euro commercial paper. And then we have the Euro dollar interest rate futures, which is predominantly used as a hedging mechanism, because a lot of the banks we're talking about loans and instruments that are based on interest rates, and because these are fluctuating interest rates, the LIBOR, the Paribor, and so on, the PIBOR, and so on, they are changing from day to day. So in this case, we're talking about a lot of interest rate risk. And so in typical finance feature, we have to hedge our interest rate risk. And so we have a contract very much the same as what you would have in derivatives, a futures contract that can be used to settle on the interest rate. And then we can also have forward rate agreements, right? A forward rate agreement is pretty much similar to what we can see as an over-the-counter option of the futures, the Euro dollar futures. So in this case, the buyer agrees to pay the seller an increased interest cost on a notional amount if interest rates fall, and the seller agrees to pay the buyer the increased interest rate cost if the interest rate increase above the agreed rate. So forward rate agreements allows you to lock into a certain rate. For the loan or deposit. And here, obviously, the buyer has a different view on the interest rate risk than the seller. Otherwise, we would not have any transactions going on. That is typically the case in any financial transactions. The buyer and the sellers will have different views of what the future on that security is in order to have a transaction. And you can also use forward rate agreements to speculate on the future course of interest rates. Now, this acts very much like the forward rates that you see in derivatives, so I'm not going to spend too much time on this, but this is a very fascinating product and used a lot by financial intermediaries. And then we also have international loan syndication that we talked about how each of those instruments are underwritten by a collection of investment banks and banks, right? So a syndicated loan or a syndicated bank facility is structured financing arranged by a group of commercial banks or investment banks, and they are referred to as the syndicate. The loan terms, right? And then lenders provide syndicated loans when a project requires too large a loan for a single lender, when the expertise from specialized lenders are needed, right? So sometimes you can have specific investment bankers that are specialized in, say, euro credits, or they're specializing in forward rate agreements and so on. And so they can just come together and syndicate a loan together. And it also allows them to spread the risk and take part in terms of financial opportunities that may be too large for their own capital base offers. And this also spreads, as what I said before, the credit risk. So this is an example of a syndicated loan that took place in 2001 by Starwood's Hotels and Resorts Worldwide. They're now merged with Marriott's. So basically, this tells you an idea of what the loan terms look like, right? So this is for $250 million. So this is a euro-dollar instrument. It's a 2-year term loan. And they specify the loan purpose to finance their general corporate operations. The pricing, the reference rate is the LIBOR plus 125 basis points. They specify the fees. And then they talk about who is the lead manager, Deutsche Bank. And then the book runner, there is definition here. And who are the participants? Deutsche Bank, Bank One, Citibank, Credit Lyonnais, and UBS. So we have a consortium of American, French, as well as Swiss banks in this entire syndication. And then the main or the lead administrative bank is Deutsche Bank. So that's how they come together to share the capital base, to finance a really big loan, and also to share the credit risk. Questions? Yes? The loan is for general corporate purposes. At the top there, yes. Yes. But they're not going to be too detailed about what they're going to use it for, right? It could be for general corporate expenses. It could be to repay interest payments on previous loans. It could be paying for expansion. It could be paying for mergers and acquisition and so on, right? Or it could be, in the case of Apple, in the past 2 years, but I'm going to talk about this a little later on, is when they think that the interest rate in some countries to be very low, they want to jump in and get the money at a very attractive price right now, right? So I'm going to talk about that. Yes, this was before the merger. They only merged, I think, in 2 years ago, yeah. Yes? Management fees are always set in any public offerings. They are always specified. I think it's the pricing margin, the commitment fee is up there, and the pricing itself, because it's a loan, it's sort of the fee that you pay, right, to the bank. Yes. Okay. So this one is missing the segregated management fee that goes to each of the bank. Yeah. So what Jim said is that he used to work on something like this, and then the biggest part of the fees in these goes to the lead bank, right? So you want to be the lead bank in some case. Okay, so this is the very exciting stuff for the debt market. If you are working in a investment bank. So we talked about the different instruments and different organizational types that banks can choose. Why would banks want to go international? We have talked about some of those before. We have talked about that banks would want to expand into foreign markets for gains in terms of their profits, or they want to get information, right? So these are summaries of some of those. So the first one that's being summarized here is low marginal costs, right? So you think that the managerial marketing knowledge, basically the human capital and human expertise, can be used and leveraged in your foreign expansion, so you want to go international. Knowledge advantage. So the foreign bank subsidiary can draw on the parent bank's knowledge of personal contacts and credit investigations for use in that foreign market. This is more for the lower cost. Home nation information advantage. Local firms in a foreign market may be able to obtain more complete information on trade and financial markets in the multinational bank's home nation than is obtainable from foreign domestic banks. So what kind of organizational form do you think fit this purpose the best? Subsidiary, maybe just purely for an informational perspective. What kind of organizational form is the best? So suppose this came up to you as a multiple choice question. You just want information, you don't care so much about expanding into the market at this moment. Representative offices, right? So representative offices are a perfect organizational form if that is the sole purpose of the bank, right? Very good, very good. Prestige, because if you are trying to have partnerships with foreign domestic banks, there is conflict of interest, right? If they give you the information, you are essentially their competitors, so they're not as likely to give you the information as if you have your own people working there to collect the information. Prestige, very large multinational banks will have high perceived prestige, which can be attractive to new clients, right? So that's why when we are talking about the big banks in the world, we quickly come to think of just a select few, and then we bank with them. So if you're able to establish international presence, that will help to improve your improve your visibility to potential clients, right? So that's very good. Regulatory advantage, multinational banks are often not subject to the same regulations as domestic banks. Very good. Wholesale defensive strategy. Banks follow their multinational customers abroad to avoid losing their business at home and abroad. So this is usually the case if you have a really large corporation or net worth individual that you care about not losing their business. Or if you are a country where you have a lot of people working in a different country, as in the case of European countries, where they could live in one country, but they work in a different country. And you might want to make banking much easier for them. So that goes into this one. And then we have transaction costs. This is what we really talked about to avoid. This goes with the regulatory arbitrage as well. They may be able to circumvent government currency controls. And then we're looking for growth opportunities. At the end of the whole day, we're talking about extra profits and risk reduction. If we operate in multiple different markets, then the business cycles in the different markets may not correlate as much with each other. So our profits at home probably can achieve some sort of diversification. Okay, so after talking about all of that, that's benefits for the bank. For us, we more care about, do global banks actually bring benefits? Well, the question is twofold. As with everything, it's never a just right and just wrong answer. You have to talk about different perspectives, different contexts. If markets are perfectly competitive, loan pricing should be determined just by borrower risk, right? So in that case, this means that if markets are perfectly competitive, is there advantage to global banking? No, right? No. Because if we're talking about global banking, we're talking about something that goes beyond borrower risk. We're talking about now institutional characteristics. So now we enter the realm of when there are frictions. When we're talking about frictions, we're talking about regulations, information asymmetry, and etc. So in this case, loan pricing would be affected by both bank characteristics as well as just credit risk. And bank linkages would be able then, in this case, to offer a value beyond a simple provider of funds. What are they? Well, entry of foreign banks may be able to offer a spillover of expertise, right? So a spillover effect of human capital and knowledge. Because we may have more banks in developed markets going into emerging markets. So the banks in developed markets can take their knowledge, know-how, and share this information with those of the local banks in an emerging market, helping them to become better and more sophisticated in their banking practices. So that's the first one. Increased competition. If you have an emerging market with just a few banks, the entry of global banks can add competition to the economy. And so more competition, what does that mean? That means lower transaction costs, well, in terms of the bid-ask spread between loans and savings, right? So that's, in a way, really good for the local economy, right? If you have more competition, then the borrowing cost for the local borrowers may be lower because they're competing, the banks are competing to give loans to people. So they cannot keep a higher rate. So that's the same thing as in more competition in, say, the supermarkets. And international banking flow will also be able to interact with other types of flows. They bring in foreign direct investments. If you have a sophisticated banking intermediary set up, then this is going to attract other types of capital inflow. And capital inflow is good for an economy because they allow this money to be invested in local positive NPV projects, right? We talk about capital inflow and how important they are for investment projects. So in this case, they can allow for more efficient resource allocation, better access to finance at lower costs, right, as we talked about. 1, 2, 3. So this one is for 2. So this one is 1 and 2. And international opportunities, that's for 3. Deepened local capital markets, so that's basically 1, 2, 3, and enhanced financial integration, so that's 3. So all of this, different points up here, result in better benefits for the host country if things go well. And they could ideally offer risk sharing and helping to stabilize the local credit supply in a local crisis. It matters, right? Because if there is a local crisis, why would the presence of an international bank help to stabilize the local credit supply? So local credit supply means the amount of money that are available to be lent to a local business. If there is a local recession, why would we care about the presence of a global bank? Pardon? Yes, right? Because if you only relied on domestic banks, you have a local recession. The entire money supply and the money base has decreased, right? So even if local banks want to lend to you, they couldn't because they just don't have enough money. Now, when we have a foreign bank in the local market in a local crisis situation, then it's good because the foreign bank's home country is not affected by this local crisis, right? So the foreign bank can go to their home country and get capital inflow from their home country and lend at this case. Yes, if things go well. Yes. So Jim is giving an example of such that, yes.
So if a Southeast Asian country...
Sorry, can you... So I don't have to...
So in general, if a Southeast Asian country is in financial distress, but then they have important projects like building a road, bridge, then there's the OECD guidelines saying that you can borrow from European or American market for as long as 18 years at Euribor spread. So it means nothing.
Right.
And then that, if you borrow locally, it will be 10 to 15% interest. So that is the way of the world economy tries to help developing markets to fight against business cycles.
Definitely. So Jim has offered a really good example, thank you very much, of how having access to foreign access to having access to foreign capital is really good to help a local economy to get out of a recession, right, or economic contraction. So what Jim offered is a little slightly bigger than what we're talking about because we're talking about international financial organizations coming in to help, right? So we're talking about the IMFs, the World Banks. They're yes. Yes. Yes, but they do need the backing of the ECB, one of the international banks as a backing, because otherwise they may not actually, if just doing it by their own, on their own, they might not want to do that, but with the backing of some international intermediary, they are going to do that. Yes, so what Jim said does indeed fall in here. So basically, it's in the case of, say, in the European crisis, HSBC, our favorite bank, is going to issue loans through backing of the ECB. Oh, sorry. Assume it's on the right slide. I'm going to make it right. You might have noticed as of last week, I started rewriting everything. Because in the mid-semester review, one of you complained that my writing was too messy, so I take recommendations as much as I could. So assuming this is on the right slide, so through the ECB backing, which they back 95% at, say, Euribor, which is really, really low compared to if they are going to lend on their home country, which is 10 to 15%, right? So that is definitely one of the advantages at how having access to international banking through the backing of a IMF or World Bank or ECB or any other central banks can really help to pull you out of trouble. Okay, back to the right slide. Sorry about that. Okay, so in this case, institutional environment is critical and determine whether or not we are able to realize the benefits that we have talked about. And that determines on whether the host financial system is able to handle such capital flows. Otherwise, it might lead to credit booms and busts, as we saw in many of the countries in many of the emerging market countries. And it would be a problem if foreign banks enter new markets and earn profits at the expense of local banks. And this is a really big problem in emerging markets. What do we mean by that? Well, when foreign banks enter new markets, remember what we said, they could be subject to lower regulation, right? If they're subject to lower regulation, they don't have to have as much reserve requirements, they don't have to offer insurance, then they're able to give rates at a better rate than the local banks, right? Then they're going to take all of the cream of the crop of the markets in the local bank, in the local environment. And so they are probably going to be able to attract all the really good business in the local market. Right? Because everybody likes to have a brand name associated with who they do business with. And so if they attract all the really good credit quality business from the local market, then what's left for the local banks? Basically, this is going to depress the local banking business and development. So that would be a really bad thing. So that leads to cherry picking and worsened access to finance for the general average of the market, right? Because what you want is to be able to lend to both the very good and some dubious lenders, borrowers. You are sure that you're going to get your money back. Well, you're more certain that you're going to get your money back from those with very good credit ratings to offset the risk that you have higher risk from those with less credit ratings, which are the subprime borrowers. And once all of the really good ones goes to international banks, then the really bad ones are left with the local banks. So the local banks are going to have much higher risks to default, to bad loans, and so on. So that's going to be bad for the local market. And also, this linkage in banks through international banking could lead to financial crisis contagion. The idea is that it's good if we are having a local crisis and we want to have access to foreign money. But the problem is the crisis from the home country of the global bank can also come to be contagious for the local environment. So in this case, if a local country, if a host country becomes reliant on foreign money, then it would be a problem if the foreign money is pulled away, right? So that's sometimes when you see countries implementing capital controls. They are concerned about hot money and cold money, that they're going to leave the country and cause a big fluctuation in the local market. So we have two cases in mind. The very first case is the credit booms in the Asian financial crisis, right? So basically, this follows from a lot of economic expansion from the inflow or the influx of foreign capital in the Asian region. So that led to domestic price bubbles in East Asia, especially in real estate. And once the bubble bursts because of some kind of economic contraction, then all of these banks want to pull their money out. And then we also have international financiers trying to target shorting the currency of the local markets. So that is going to result in a really bad case for the local market. So I'll leave you to read about that. It's very well known. And we also have the case of financial contagion in the not so distant global financial crisis, with what started in the US as a purely domestic subprime mortgage problem. And because of the linkage between international banks, how these subprime mortgages were repackaged into securities that were sold off as really good quality securities to banks and financial institutions worldwide. And then when the mortgage rates increased and then many borrowers in the US defaulted, this problem spread to the rest of the world. So we have country pension funds, say in Norway, that has been hit significantly as a result of this. So international banking linkages can really lead to problems if we are not careful about how they are managed. Okay, so in response to all of these concerns and in response to what we have mentioned at the beginning of this regulatory arbitrage, regulators are increasingly scrutinizing this offshore market, right? So they want tightened rules and regulations on the banks. So here, Fed wants to tighten liquidity rules for foreign banks. They want them to hold more liquid assets, so that is to increase capital reserve. And that's why we see all the different versions of Basel being rolled out. And then we also have the case where the Fed is going to pay more scrutiny on foreign banks. They're going to sort them into 4 different tiers based on their perceived riskiness and so on. And then you can read about those as well. So this is what I'm talking about. International agencies as well as national agencies are more and more looking into closing the loophole on making international banking more regulated. But as a result, we could see a sort of a change in these markets from what we are seeing them now, because this is going to change their cost-benefit structure as what we have talked about. So perhaps in 2 years' time, when you looked at this again, it could be changed. Okay. All right, so that concludes our discussion for international banking. For this class, let's take a 5-minute break, and then we'll come back and start on the bond and equity markets. Thanks. Sorry, I think I'm having a technical difficulty here. Hi, I'm at Cambridge MCH, and I'm on break here, but then my screen just went blue. Actually, no, on the projector. Yes. Well, I'm pressing on it. Yeah, I tried to change the sources, but it's not doing anything. It's still just blue. Oh, now it changed. Oh, okay. I think it's now sort of changing in a way. I pressed on wireless, and it somehow responded. But then I now wanted to change to my laptop, HDMI plate, but then it's just frozen on the wireless screen. Nothing has happened. Yes. To shut it down? To shut which down? To shut down which one? To shut down the projector? Yes. So you want me to turn it off? Okay. So I pressed on it. And now you went back. No, okay, you flipped from off to on, and now it's blue on, projector off. No. I think it's refusing, like nothing is, it's not doing anything. The light is not going on in the projector. No. Because it flips from being blue on projector on to being blue on projector off. Yes, I have a class going on at the moment. MCH. Please do, thank you. I have a 3-hour class here. It finishes at 6. At this phone. Um, 55543. 55543. 5645155. 5155. Please do. Thank you. Sorry about this. Okay, what do we do? Do you have access to your files on your laptops? I would really hate for us to lose time because of this. This is called uncertainty, technical uncertainty, that you have to hedge. Huh? Is an example. Yes. Okay, all right. How do we do this? There is a whiteboard, but I don't think you can see. All right. Okay. If you wouldn't mind, I'm not going to write down too much because a lot of it could be done by talking. If you have access to your laptops or your phones and you can see the slides on your, hey, it's on. Okay. I don't really know what's happening with this. I'm going to wait for it to do its thing and for somebody to come and do its thing. But anyways, so let's carry this on. Thank you and sorry about this. I really did not anticipate on this. I thought it settled down, but never mind. So we're going to be talking about an extension to international banking because so far we have talked about how international banks provided extra ways for corporations to get their financing. Now we're doing an extension on those and look on the side of the banks and look at how they get their financing, right? Because banks cannot just give you money to invest. They need some source of fund, right? So we're going to be talking about the sources of funds for banks. And so we're going to be, if you actually look into the PowerPoint slides or not, so basically, we're going to be looking at how banks get their funding. So if we look at a bank's balance sheet, there's basically assets and there's also liability, right? So what represents assets to a bank? Deposits or mortgages? Mortgages, right? And deposits represent a liability for the bank because if we deposit our money into a bank, we have to get our money back. This is a loan to a bank. But then for a bank, a mortgage it makes that it lends to other people is expecting to get the principal plus interest back. So that represents an asset to the bank. So basically, we're looking at the mismatch between how the bank gets money from us and transfer it into its asset or mortgages or its investment projects. Right? So there are three major sources of funds for banks. The first one is equity financing and retained earnings, right? That's the typical financing for any internal financing for any bank, companies. And then the second source, we already talked about before, is deposits, if it is a deposit-taking institution, right? So we have deposits from retail investors like you and I, and we also have corporations who are also putting in their savings with banks. So those form a second source of funding from the bank. And then there is a third source of fund for the banks, and that is the wholesale funding market on what we just talked about in the international money market. So that is where the bank can also borrow money from, right? So we're going to be looking at the difference between deposits as well as wholesale funding. For deposits, for Canadian and US banks, they are universal banks. We all go to a bank in Canada and the US and get our mutual funds and get our deposits taken care of. So it's a one-stop shop, right? There is no competition. But it's different in Australia. What's so different about Australia? There is competition for deposit. And that comes from superannuation. Because you can put your money into superannuation or you can put your money into deposits, right? So for Australian banks, there is competition in the deposit-taking arena. what is characteristic about deposits in any financial institution? Do we care about what happens to our deposits once we put it in a bank, other than we're getting our regular interest rate? I don't. I don't know about you. I just put the money in there and I check whether or not I'm getting my interest payments, and that's about it, right? So as a whole, for deposits that are with a bank, especially retail deposits, they're pretty passive, right? And if you actually save money in long-term interest, in long-term savings account, it's also probably for a long term, right? So we have passive, long-term, unsophisticated savings. And these are also very good, stable sources of funding, right? Because once we put the money in and lock into long-term savings account, then it's locked in. Otherwise, we get penalized if we take it out early, right? So they're pretty stable. They're pretty passive. Yet, they're also very limited. Because if we look around, the savings rate across all of the countries are pretty low, especially in the developed markets, right? So the funding from this passive and stable source of deposits as a source of fund for banks is limited. So if a bank wants to make money, then they have to turn to the third source, the wholesale banking, the wholesale funding source. And that's going into the international banking market, the interbank market that we just talked about in the previous hour, right? So in that case, which slide are we now? So in that case, we're going to be looking at comparing with deposits and wholesale, short-term wholesale funds. So that is slide 6 on your slides. So when we're talking about banks taking their money, borrowing their money on the interbank wholesale funding market, what is characteristic of this source of fund? They are borrowing from other large banks, right? So these other large banks care about their returns. We talked about these are usually unsecured loans, right? So they're going to, so your lenders in the interbank market or the wholesale market is going to be monitoring your projects very closely. So these are termed what we call sophisticated lenders, right? And the interbank market is also very liquid. We have many of these big banks, big corporations participating in this wholesale funding market or this interbank market at any point in time. So it is short-term, liquid, and also sophisticated lenders that we're talking about. So it sounds really good, right? It sounds really good, and what's the problem? So we're going into talking about some of the potential problems associated with short-term wholesale funding. Okay, so with some of the problems with short-term wholesale funding, also it's coming from its potential benefits. So if you go on to slide number 7, we talk about how it is an additional funding source for a bank to fully exploit valuable investment opportunities, right? It provides market discipline because we have sophisticated lenders who are capable of monitoring the borrower's investment projects. So if the bank takes the money, the borrower bank takes the money and invests it in bad projects, then the lender can see that and monitor that and then terminate their funding to the bad investment project. So in a way, it looks efficient. And it allows only the good projects to go on. So economically speaking, it's welfare increasing, right? However, it becomes a problem because in normal times, the lending rate or the reference rate is upward sloping. And upward sloping lending rate means that in the short term, you're able to get low rates and the rates go up as maturity increases. So if we're talking for a bank who is borrowing money in the short term and getting their investment returns in the long term, it's good because the short-term rates are lower than the long-term investment return rates, right? That's how the bank makes money, the spread, right? It becomes a problem precisely on this point and precisely on how liquid this market is if things go wrong. So if you go on to slide 8, right? If you go on to slide 8, there are some of the problems that we can see that can cause interruption to this market. And they include physical interruptions, counterparty risk, liquidity hoarding, and forced liquidation of projects appearing to make a loss in the short term. So these projects could be profit-making in the long term, but in the short term, if they are making a loss and your lender bank cares about an immediate return, then they are going to liquidate your project too early. So cases of that are 9/11. So when the planes hit, several of those major financial firms are hit badly physically because of the Twin Towers and so on. The collapse of Continental Illinois is because of that, and Northern Rock, as well as Bear Stearns, as well as the financial crisis, are all cases of where this reliance on wholesale funding went wrong. So there has been many studies that looked at the liquidity risk as well as the problems associated with the wholesale funding market. So if you look at slide 9, there has been the studies that are published in really well-known papers, journals such as the Journal of Financial Economics. The Fed has papers on this. The IMF have papers on this. So basically, that identify the courses on which banks were able to survive from the financial crisis and which banks were not. They basically concluded that banks that relied more on the wholesale funding market during the financial crisis were the ones that were most hit, right? During the financial crisis, we are talking about a global financial credit crunch, right? So each and every single bank, wherever they are operating, they are all concerned because their national regulators are looking carefully on their lending behavior. Their investors are looking carefully at their lending behavior. Even if they spot a really good investment opportunity, they are a little concerned about lending the money, concerned about bad lashback. So the case of Northern Rock is a really, really good example. And I think this is a really important example that embodies how bad things can go if you rely too much on wholesale funding. So the case of Northern Rock is a 140-year-old bank in Britain, right? And it went bad. Things went bad for Northern Rock in September 2007. So what happened is that I think about 70% of its total funding came from wholesale funding. All right, so 70% of its total source of funding came from wholesale funding. Its entire loan book consists of a lot of mortgages. But unlike the US counterpart, the mortgages that they made are to really good quality borrowers. So they are not part of the subprime mortgage debacle, right? So their loan book looks really good, but because of the subprime mortgage crisis that originated in the US and all of the lenders, the typical lenders in the international money market, they suddenly refrained from lending money. And they started calling back loans that they have made to existing banks. Okay, so they started recalling loans to existing banks. So in the case of Northern Rock, because 70% of its loans were financed by the wholesale funding market, the lenders in the wholesale funding market started to call back the loans that they have made. What's happening to Northern Rock? Right, and then its assets are still lent out to borrowers, right? It cannot take the money back. So then now we're starting to see a mismatch, right? Northern Rock, it's in a ditch. Basically, its lenders wants money back. It doesn't have the money, yet it has a really healthy mortgage book. And then at the first width of the problem, the things goes bad. All the retail investors, they're concerned about their deposits, right? And then all of the people lined up to try to get their retail deposits back. So now you have their retail source of fund wants to get their money back. The wholesale source of fund tried to get their money back, and their money is tied up in their mortgages. So what happened to Northern Rock? It went bankrupt, right? So this is a case where if a bank, during the good times, if they relied on the wholesale funding market, it's a really good source of flexible and immediate and very timely source of fund. But when times go bad, then we have a liquidity crunch, or the dry up of liquidity across the entire market, across the globe, right, during the financial crisis. And that is going to cause problems to a lot of banks that rely on too much wholesale funding. So a lot of the Canadian banks were exempt from this impact because a lot of the Canadian banks are under really tight domestic regulation to not rely on wholesale funding, but to expand their retail deposit-taking business. So they were not really exposed to this. And of course, Australia is also not exposed to this as well. So sorry that I have to talk about this to you like this. I hope it comes across really well. Are there any questions of how this goes in terms of the sequence of events? Questions? Let's think about this, because I said this is very important to understand.
So switching to PC, fine. Yeah, and it's showing on the screen, yeah. Laptop, I want to switch back to laptop.
Oh, so while we're having a break at this moment, I want to take your attention to the Wattle. I have set up a poll on Wattle under the problem sets and final exam sample section, where you can put in you can vote for which problems on the problem set that you want me to go over next week in the review session, right? I can take votes up to the Tuesday, midnight, before next week's class, and I'll take as much as I could without any of the problems to go over those problems in the review section next class. And if we couldn't finish this on time, what do you want me to do? Do you want me to just record this on my own in my office, or do you want to have a rescheduled class? Rescheduled class. That's going to make it really tight. I'll try my best to arrange that, right? Because I truly do believe that it's nice if we're able to meet together and talk about this. But I think now we have a scheduling problem. Oh, yes. But I think I'm actually quite a bit behind in terms of the time. So we will not be able to finish everything today. So I'll let you know. If I'm able to reschedule a class, I will do it, right? Otherwise, I will definitely record everything and do my best to talk your brains out. Sorry. Okay. All right. So, any questions about Northern Rock and how over-reliance on wholesale funding can lead to problems? All right. Very good. So let's now do a little bit of a regression and go back into the big picture. Oh, I forgot to say thanks. Anyways, that's bad manners. Okay, so here we're back to looking at the big picture, right? We just talked about the bank loans and syndications market. We also talked about the euro currency market. So those are the two markets that we just talked about. And we talked about the banks financing corporations as well as how the banks finance themselves on the wholesale market or this market. So basically, we're taking this as the wholesale interbank market from the perspective of banks. And then we're going to be looking at the remainder of the debt market, which is the international bond market. So in general, the international bond markets are just a bit longer in terms of maturity, and they also pay coupons, typically, if they are established. So these are some of the market statistics in terms of the international debt market. That includes both the bank loans instruments as well as the bond instruments. So in the first panel, we can see which of the markets issue international debt the most. So the red line is TDS. So TDS is total debt securities. And the DDS is the domestic debt securities, and the yellow line is the foreign international debt securities. And if we're looking at different sectors, then who are the issuers of these bonds? The red line is general government, so governments issue the most debt. And then the blue line, the next one is financial corporations. So that's where we are talking about banks need to finance themselves. And then the yellow line here is non-financial corporations. So these are the corporate loans. And then these ones are for households and non-profit institutions. And then in terms of the currency of denomination, the most popular debts are issued in US dollars, followed by, if we're looking at other denominations, euro and the Japanese yen. And the purple line here is a conglomeration of all the other currencies. So this market, the debt market, is very important. And we're going to be looking at the second component of the debt market in addition to the banking and money market today. So topic 7, we have laid the groundwork for how to access international opportunities in terms of lower the cost of capital, right? And so we went on to international banking. With international banking, because of less regulations, you can potentially get a lower cost of financing, and corporations love that. And then let's see how we can do that with international bond and equity markets. Okay. So bonds, as we all know, are debt securities issued by, we're not talking about anything here, issued by organizations to raise funds for its operations and investments, or to refinance their maturing debt. So that's the purpose of the debt that you have to specify. On the other hand, if we're talking about equity financing, analogously, we are talking about issuing stocks or shares in the company and sell them off to public investors. If we're comparing the two markets, the global bond market far dominates the global equity markets by roughly a half. So 96 trillion in the bond market and 69 trillion in the stock market. But you don't hear about the bond market as much as a retail investor, because most of the players on the bond market are wholesale participants, right? So they're large cap. So that's why you don't hear so much about them, but they are more important. So the distribution of market capitalization in both the bond market and the equity market are approximately 40% within the US and 60% outside of the US. So US is the dominant player in both of the markets. And as we saw in the global debt issuance, the US dollar denominated debt was the most important, right? So in this case, most bonds are denominated in euro, US dollar, pound, Japanese yen. Bonds. So we're looking at the bond market right now. In terms of bond market, there are domestic bonds and there are international bonds. Obviously, we're more interested in the international bonds. And there are 3 main categories of international bonds that we're interested in, which are the foreign bonds, Euro bonds, and global bonds, right? From Australia's perspective, how many domestic bonds and foreign bonds is Australia issuing? Well, let's look at this. So the pale blue part is bonds issued by Australian corporations offshore. So those are the global bonds, whereas the green part are domestic bonds issued within Australia. So we can see that corporations and banks in particular issue a lot of more percentage of their bonds offshore, right? So this is very important. Foreign bonds. What are foreign bonds? Well, foreign bonds are sold principally within a single country, and they're denominated in the currency of that country. It's issued locally by a foreign borrower, usually denominated in the local currency and sold principally within that market. They're the same thing. I don't know why they're sorry about that. They are underwritten by an investment bank or a syndicate investment bank, a syndicate of investment banks in accordance with domestic security laws, requiring pre-offering registration or disclosure requirements. So this is going to be a big distinguishing feature between foreign bonds and the rest of and the Euro bonds that we're going to talk about. This idea of pre-registration and more tight regulations, right? As by now, regulations means higher costs. So if we're talking about regulations, then we are expecting higher costs, right? So example, a German company issues a bond denominated in US dollars and sells it in the US. And it's underwritten by Deutsche Bank and follows the rules of the US Securities and Exchange Commission. The underwriting bank can be a foreign bank and can be a local bank. Deutsche Bank has a big presence in the US, so it's pretty blurred there. And they are under the SEC's regulation. So investors like foreign bonds because usually that offers diversification to the local portfolio. Right? Because if we're talking about the selling of a product, we have to have a demand in order for the product to be successfully sold. So in this case, foreign bonds, especially for those foreign bonds by companies with good credit ratings, they are highly sought after. Foreign bonds comes with very distinctive street names. Finance professionals love to give street names to their products and instruments. And this is something that you need to know if you want to work in the finance industry, so you know what they're talking about. Okay? So these are pretty, I think, self-explanatory types of names that are given to the bonds, the foreign bonds that we see. What's the first one? Yankee, the Yankee bonds, absolutely. So these are foreign bonds denominated in the US, issued by a foreign company and sold to Americans. So these are called Yankee bonds. This one, Samurai, right? Samurai bonds, they are bonds sold where? Japan, yes. They are foreign bonds sold in Japan. What about this? Bulldogs. Where are they sold? UK, right? So there are foreign bonds sold in the UK. We have a very relaxed-looking kangaroo here, so we can assume safely that these are foreign bonds sold in Australia. So they can either be called kangaroo bonds or Matilda bonds, right? The waltzing Matilda, which almost became the national anthem of Australia. And then we have this. Maple leaf, so that's Canadian foreign bonds. And then we have this cute little creature. We have panda bonds, and so those are the foreign bonds sold in China, right? So you are expected to know what these refer to. Foreign bonds, as I said, a distinguishing feature is tight regulations. So panda bonds are becoming more and more popular in the past few years as foreign investors are trying to exploit the potential, the market potential, the very big market potential in China. So BNP Paribas in 2018 received a license to be the lead underwriter for yuan-denominated bonds for foreign non-financial corporate issuers in China. So these are usually very tightly controlled. And it is the third bank following HSBC and Standard Chartered Bank to receive license to issue panda bonds in China. So if you are a foreign company and you want to issue panda bonds in China, then you have to go through either HSBC, Standard Chartered, or BNP Paribas in order to do it. Okay? You can't just go to anyone. So this is the second type of international bond, which is called Eurobonds. So Eurobonds are bonds issued outside the issuer's home country, and they're sold to investors residing in various markets. And they're usually denominated in a currency other than the country of placement. Okay? So in this case, let's take a look at an example. It is a bond that is issued by a firm, and it's denominated in the US dollar, sold to investors in Europe and Japan. So notice, neither Europe nor Japan have currencies of they both have different currencies as the US dollar. And Eurobonds are usually not sold to investors in the US. And they're typically issued by large corporations, multinational companies, sovereign governments, semi-governments, which are the governmental enterprises, as well as international institutions. International institutions such as the World Bank, IMF, and the major international agencies. Okay, so the Eurobond market is often referred to as the supranational market because the bonds are simultaneously issued in various different countries, and so they are under very loose regulations. And once they are under very loose regulations, what do we expect in terms of the cost? Lower cost, right? We would expect that the interests on these bonds are going to be lower, the coupon. So that is also why the coupon, the Euro bonds are more popular than foreign bonds. Less red tape, faster to issue. Probably cheaper. All right. So Euro bonds are also predominantly in bearer form, so that's what we call a bearer bond. We're going to have a slide on this in just a couple of slides, but just bear with me right now. So similar to foreign bonds, there are common references to Euro bonds. So Euro bonds, if they are US dollar Euro bonds, then they're called Euro dollar bonds. It's pretty not tacky in a way, but they're also called reverse Yankee bonds. Okay. We also have yen Euro bonds. Now that becomes a bit more interesting. Then they're called sushi bonds. Okay. And we also have Euro Swiss bonds, and we also have Euro yuan bonds, which are the dim sum bonds. So the dim sum bonds are essentially bonds issued by mainland Chinese corporations in Hong Kong specifically. They are issued in the Hong Kong market, and then they are called dim sum bonds. And then, in terms of the special names, we also have Kung Fu bonds, right? So Kung Fu bonds are offshore US dollar denominated bonds issued by Chinese corporations worldwide. So these are US dollar denominated bonds, whereas the dim sum bond is Chinese yuan denominated bond. So this arises from tighter regulations and rising funding costs in China, which pushes many firms to shift their fundraising activities from the onshore market to the offshore market. So that is really one of the big things that drives companies to, instead of issuing domestic bonds, to issue offshore or global bonds, right? This is true for any companies that are in the global bond market. Chinese issuance of dollar bonds now make up nearly 70% of corporate dollar bonds in Asia, other than Japan. So most of the companies that issued Kung Fu bonds by industry are financials, 56%, and then we have major tech giants like Tencent and Alibaba. They issue the technology bonds. materials, utilities, and energy. So these are a lot of these state-owned enterprises. They issue Kung Fu bonds. So we have the major bond issuers in this arena. And then we also see very recently Tencent, so April 4th, has raised $6 billion in terms of bond sales. And we can see that what are some of the features that we see. So we can see that it's $6 billion in US dollars. And we can see the interest rate features on this bond. So $2 billion in fixed and floating rate 5-year notes, $500 million in 7-year notes, $3 billion in 10-year notes, and $500 million in 30-year notes. So they're in different tranches with different maturities and different interest rates, right? It's very typical of a major bond issue. You have different maturities and different interest rates. So they're in different tranches. In tranches by maturity and interest rate, or in this case, coupon rate. And it is filed on the Hong Kong Stock Exchange to be listed on the Hong Kong Stock Exchange. And the coupon rates are here. And then these are the syndicate of underwriters for this bond. Deutsche Bank, HSBC, Goldman Sachs, Morgan Stanley, they are the joint coordinators for the sale. So whenever there are news items for bond issuance, you should be able to see all of the different details for that. Okay, so now comes to the special terms. We talked about most of the Euro bonds come in bearer form with call provisions and sinking funds. So now we talk about a difference between bearer bonds and registered bonds. The main difference is whether it comes with evidence of ownership. If it is a bearer bond, it's just like money. Whoever holds the cash is the owner of the money, right? Whereas for a registered bond, basically on that piece of paper, it's going to say, it's like an award certificate. On the piece of paper, it's going to say that this money belongs to FAN, right? And if somebody else picks up this piece of the certificate, they cannot claim ownership to it. And so the ownership of a registered bond, which is typically the case for foreign bonds, are registered with the company itself. And it's registered also with the exchange. So which one do you think is cheaper to issue? Registered bonds or bearer bonds? Bearer bonds. There's less red tape, less processing involved, and so there's going to be less cost. So now we should always jump whenever we see cost and extra process, that means extra cost. Okay. So because of the feature of the less cost, it's less costly, so it offers lower yield, which is something that we want. And for people who cares about this bearer bond or this anonymity, they would want privacy for example, tax evasion, tax management, right? It's very easy to hide a pile of cash, well, in your vault, in a way. But once it's registered with some enterprise, then it's much more difficult to hide it. So for people who care about anonymity and privacy, they will much more prefer to have bearer bonds. And then we also have call provisions. So basically, these are additional provisions on the bond that allows the issuer to call the bond in prior to maturity. So, and then we have also sinking funds. Sinking funds are a way they are established by the fund where they put a pool of money in there to ensure, sort of like a collateral, that the interest payments and the principal repayments are going to be made. So those are the features of a typical Eurobond. And then we have something that is called the global bond. So the global bond is typically a very large bond issue that's simultaneously sold and traded in major markets worldwide without restriction. And they are usually traded also in the market of the issuer as well, which is unlike the Eurobond. The Eurobond usually is not traded in the market of the issuer, right? Okay, so that's the major difference. The World Bank is the first to create the concept of the global bond, and is also the first issuer of the global bond. So this, because of the features of the global bond, very large bond issue, and simultaneous trading, it requires that the bond issuer to be an issuer of very high credit rating and very reliable. Otherwise, this can create catastrophe for the worldwide market. And also, this is a very liquid market. If we have a global bond and we have a US dollar denominated part of it that is sold in the US, then it is classified as a foreign bond, which we also call a Yankee bond, right? So this is all the terminology in the bond market. I did not create it, but if you are going to understand the bond market and newspaper items, you have to know. Otherwise it's going to be very difficult to understand. This is just getting to know the language. Okay, so, sorry, this is very small. But anyway, so this is just taking the World Bank example to show you about the bond. So basically, they say the World Bank say they are the global bond pioneer. They are the first one to issue a US dollar global bond in 1989, followed by in 1990, the New Zealand dollar global bond, Japanese yen, Deutsche Mark, Mexican peso, Turkish lira. So the World Bank typically issues these very large bond issues to help with economic assistance in the various countries that they're trying to raise the funding from. And then we see the terms of the bond. The issue size is about 2 to 4 billion, so it's really big. We're going into billions now. And there are several tranches. We are offering maturity in terms of 2 years, 5 years, 7 years, 10 to 30 years. There's the coupon payment specified. It's listed on the Luxembourg Stock Exchange. A lot of the bonds are listed in the Luxembourg Stock Exchange. And it is a registered bond. And it is cleared at a major clearing house, and it is governed by New York for US dollar bonds and English law for the euro part of the bond. So it could come in either the US dollar or the euro. It is, in a way, dual currency bond, which we are going to talk about in a few slides. So this spill tells very much about why issuers want to issue bonds as big as this, and why would investors want to invest in a bond as big as this, right? So for the issuer, the credit quality is very good. The World Bank, typically the default probability for the World Bank is probably better than any single government, national government. And then we have liquidity. Liquidity, they are very large in issue size. They have very diverse investor base geographically, so it diversifies the funding risks for the bank. And it's also very well regulated because it's looked after by multiple different clearing systems. And so there's a lot of liquidity and guarantee. And so if you are an investor, this is the line where you would look for portfolio opportunities, diversification of a very high quality issuer, very liquid, and also a very good return value. So other than the World Bank, BHP Billiton, which is a British Australian company, also issued a global bond. So this is an example of how important global bonds are for both international agencies, government agencies, as well as individual corporations that are really large. So this one is a bit smaller in size, which is only about US dollars 750 million in comparison to the 2 to 4 billion of the World Bank bond offering, right? So what are some of the instruments that we can use to issue bonds? Well, we can have a straight fixed rate issue, what we call. So basically, these are fixed coupon bonds that you would see already in the domestic bond market. It has a set maturity date. You have to have full principal repayment upon final maturity. So far, everything looks the same as domestic bonds. And then we also have what's called the floating rate note, FRN. And so the difference here is that the interest rate is floating, a variable rate base, where you have typically a fixed spread on top of the LIBOR. Fixed maturity, no principal repayment because it could be also perpetuity, and similar to an adjustable rate mortgage that you see. The third type of international bonds are equity-related issue. So we could have convertible bonds where you are able to convert the bond for equity, right? So it resembles the straight fixed rate issue, and it's convertible to a stock prior to maturity at a pre-specified price at a pre-specified date for a pre-specified amount of shares per bond. Or you can have a second type of equity-related issue, which are called bonds with equity warrants. So they resemble the straight fixed rate issue with a call option, which is basically the warrant. So the warrant, if you exercise it, then you can pay to purchase some fixed amount of shares from the issuer at a pre-specified time. So the difference really between the two is that if you go with the first option, you give up the bond in return for some equity shares. Whereas for the bond with equity warrants, you keep the bond and the coupon payments, and you're going to pay for additional shares in the company. So what kind of investors would be interested in these type of bonds? Why would investors want to purchase, say, equity-related issues relative to straight fixed-rate issues? Precisely. They're looking for growth. So if these bonds are issued by high-growth companies who are probably not doing incredibly well right now, but you think that is going to rise spectacularly in the future, then you want to become a shareholder, right, at a lower stock price right now. Because in the future, the stock price for the company could really increase and skyrocket. And then you just do not want to lose that opportunity. So that is also why for these equity-related issues, they come at a slightly higher cost. And investors, they don't mind that because they're buying into the growth potential, right? So that's why we would see investors liking to have these bonds. And then we have dual currency bonds that we briefly mentioned in the World Bank issue. So dual currency bonds is basically a straight fixed rate bond with principal in one currency, but the interest payment in a different currency. Japanese firms have been big issuers with coupons paid in yen and principals paid in dollars. So how does this work? Basically, you have an initial issuance date, and this is the maturity date. So during the periodic coupon payments, all of these payments are paid in yen. Right, all the way up until then. And then you have the last interest payment in yen plus dollar payment in principal. Why do you think companies want to do something like this? In the case of a company trying to expand into a foreign market. So for example, let's think about a Japanese company like Toyota trying to expand into the US. Why would they be interested in issuing a bond with this kind of feature? To pay the coupon payments in the short run with their own domestic currency, and then in the future to pay the principal back in US dollars. And remember, if they issue this bond, they're getting US dollars. So why do you think a company would want to do something like this? Yes, they set up a factory in US with. Okay, they repaid. Yep.
Basically, redistribute the retained earnings in coupon. Then they pay interest in coupon in Japanese yen to domestic.
But why would? Okay, so the idea is that Jim said that they're going to set up the company in US with the US dollar that you get from the bond issuance, and then the next point. Then
my intuition is not expansion in the US. My intuition is expansion in Japan, but they buy equipment from American exporters. So they raise this in USD and pay the American exporters without FX.
Okay.
And they will pay the coupons based on the revenue from this factory in Japan to locally.
Then why would they want to pay the final payment back in US dollars? So Jim was talking about the other case. Instead of expansion, his intuition is on the expansion. It's going to be in, instead of being in US, but it's going to be in Japan. Yes? Yes. So the idea that Luke, you're Luke, right? Thanks. So the idea that Luke is sharing with us is that as you first expand into the US market, it might take some time before the company starts to get revenue back, right? So while the company is being set up and start to actually earn money, you want to be able to ensure that the company has liquidity to repay the money. So, and you don't want to add further stress on the on exchange rate risk and everything with repaying everything in US dollars. So you're going to use domestic money from the parent in Japan, repay the loans off, repay the coupon payments, and then once the US expansion starts to make money, then you can pay off the debt in US dollars, right? So this offers this flexibility for the company to make expansions, but to not add additional pressure on, say, liquidity concerns as well as foreign exchange rate concerns, right? So this is a very, very good way for companies to manage FX risk, liquidity risk, and be able to have enough money to expand overseas. Very, very good. So very recently, Argentina, as a government itself, also sold a dual currency bond. So in this case, the bond itself is 1.6 billion. And the bonds are denominated in dollars and could be purchased either in dollars or pesos, but the repayments are going to be made in pesos, providing investors with a hedge against depreciation and also allowing the government, if it's trying to expand into other markets or use US dollars as use US dollars even within Argentina to finance operations. Because actually a lot of the business deals in Argentina, they are actually denominated in US dollars. But at the same time, the government wants to have this flexibility to print money to pay back the loans, right, in case the venture doesn't go off well. So this affords extra flexibility for the companies to manage their loans. Very good. Right, so for a company to issue Euro bonds or go on to the global debt market, cost is really the key idea. So in this recent item from Bloomberg, what we see is that the Europe's debt market is corporate America's bazaar again. So basically a lot of American companies are going to Europe to issue US dollar Euro bonds, which we call the reverse Yankee bonds. So basically this is saying that most recently the big American companies such as Altria, Coca-Cola, Ford Motor, IBM, they are issuing more and more bonds, dollar-denominated bonds in Europe. And why is that the case? That is because, right? So first of all, this is the benefits. So Europe has a more volatile funding environment compared to the US last year because of political risks and the slowing down of quantitative easing. So that's talking about Brexit and so on. So that is why last year, the reverse Yankee bonds are not so popular. But this year, the ECB announced this morning that it will keep interest rates at record lows for longer to help stimulate economic growth. Therefore, the patient stance has helped tighten spreads and made the European bond market much more appealing. So the opportunity of the Eurozone allows issuers to borrow at lower rates while diversifying their investor base. So cost and diversification are really major important factors in this. And this was the case, as I mentioned, about Apple. So Apple was sitting on like billions of cash back 2 years ago. And yet it was still issuing billions in terms of reverse Yankee bonds in the European market. And why is that the case? And that is the case of looking for cheap credit. Right? Apple, Coca-Cola, again, did that back in 2017. Why was 2017 a really good market environment for American firms to issue in the European market? Cheap cost is definitely the key factor, but what was going on in the American economy and what was going on in the European economy that made the market really attractive back in 2017 and 2016? Sorry, yes? Quantitative easing. So back in 2017, the Fed was announcing that they're going to slow down on their quantitative easing program. That means that they are not going to continue buying so much loans from corporate America, and they're probably going to start pushing up interest rates, right? But at the same time, ECB is announcing that they're going to keep interest rates at record low. So comparing the two economic environment and political will, the European market appeared much more attractive for corporate America to make debt issuance over there. So even though Apple and other companies, Apple in particular, they're sitting on a lot of cash, they're still jumping on this opportunity to get cheap debt, right? Yes? What about interest rate parity? That will, yes.
If euro's cheap, then that means that USD is going to depreciate.
Yes. So this goes back to our second topic, all the international parities. If lots of these activities are happening, it's going to cause exchange rates to move in the opposite direction, to cause your efforts to be canceled out, right? So that happened in some degree. That's why it stopped, and the market environment changed because national markets, national regulators, they see this. If everybody is going off to a different market and ignoring the local market, that's going to cause problems, right? So a lot of things are going on at the same time, violating the ceteris paribus condition for international interest rate parity to hold. So that is a good benchmark, but in this case, it's not the only force in action. So yes. So that's the kind of environment that we're seeing again very recently with the ECB's announcement. Okay, equity market overview. So we just talked about the bond market. Now we jumped into the more familiar equity market, but much smaller in terms of size. So in terms of global market capitalization at the end of 2018, this is the trend that we're seeing. The Americas is definitely the biggest in market cap still, with the blue part, the Asia Pacifics, and the green part, the emerging market economies, right? So we still have the US dominating, as we know. And then in terms of a more fine look at which kind of countries are we talking about. So the United States is the pale blue part, taking on 54.4% at the end of 2018, with Europe, but not including the United Kingdom, at 14.8%, Asia, not including Japan, taking on this much, and so on. So this tells you roughly a story of who are the major players in the global equity market. Well, equity, they have to be listed, right? Equity are traded in stock exchanges. So what are some of the big stock exchanges that we see around the world? Take a guess. New York Stock Exchange, something that we all know. Others? NASDAQ, mainly for technology stock and emerging technology, emerging industries. Others? ASX, Australian Stock Exchange, definitely. We don't forget about home. Others? Toronto Stock Exchange, yay, Canadian power. Toronto Stock Exchange, definitely. Others? Hong Kong Stock Exchange, Shanghai Stock Exchange, London Stock Exchange, Europe, Tokyo Stock Exchange, definitely. Right, so we see all the different stock exchanges in the world. Unsurprisingly, NASDAQ and NYSE are the two biggest, followed by Tokyo Stock Exchange, which is now under the Japan Exchange Group, followed by very roughly the Shanghai Stock Exchange and the Shenzhen Stock Exchange and the Hong Kong Stock Exchange, and so on. And we have London Stock Exchange and the Euronext, which is a conglomeration of the individual national exchanges in the European mainland, continental Europe. And we have Australian Stock Exchange. So keep this in mind and think about where would firms want to go listing? Because again, we are not talking about domestic listing. We're talking about international equity markets. So the idea is that a firm wants to go to a different country and list their stocks. And we're going to look at why they want to do that and what kind of considerations goes into it. Equity financing, as we say before, they're looking to issue equity. So they're ultimately trying to make an issuance, and they're going to generate the capital for funding their business and executing the business and repay their loans. And firms can predominantly raise international equity finance via Euro equity issue, as well as cross-listing, as well as cross-border IPO. So these are the three main ways, but actually cross-border IPOs are often talked about within the context of cross-listing as well. So let's take a look at what they are. Euro equity issue, the initial sale of shares in 2 or more markets in countries simultaneously. All right, so basically you're doing one IPO, but you're listing them on 2 different exchanges, 2 or more exchanges. And so why do you want to do this? You want to reach as wide of an investor base as possible. The largest and most significant issues have been made in conjunction with a wave of privatizations of state-owned enterprises, right? So those came in vogue before. So British Telecommunications was an example that used the Euro equity issue, and Gucci also used it. I'm not sure if you know about Line. So it's a Japanese company. It also used Euro equity issuance. I think it was in 2017. So state-owned companies, such as the British Telecom, when it became privatized, that's what it used. Also big corporations, they also do that. Cross-listing. This is one of the most popular ways of doing international equity issuance. Cross-listing is also called international listing or interlisting. So basically, you have a company that already has issuance or IPO within its home market, but it can also choose to have its stocks listed on a foreign market, and it can be listed on multiple different foreign markets. The choice of the foreign exchange that the company chooses depends mainly on the firm's specific motives and the willingness of the host stock market to accept the firm. And these can be summarized into 2 major considerations: liquidity of the stock market, as well as the value add comes from the stock market. What do I mean by those? The liquidity factor. Liquidity is defined by how quickly can you sell an asset without a major price concession. Okay, that means a major depreciation in your price. For example, your stock is $50 today. Liquidity, a very liquid market, means that you are able to sell the stock, hopefully at 50 or 51, if you want to quickly get rid of it. If it is a very illiquid market, you may have to offer a really big bid-ask spread. That means you have a $50 stock on your hands, but if you want to sell it immediately, you have to accept, say, $30. It's what we call the fire sale, right? So that's something that matters a lot, is that you're able to keep its value. There are multiple different measures for liquidity. One of them is the turnover ratio that is used very often. So this is calculated by the total stock market transactions that's on the market at any point in time, divided by market capitalization of the market, right? So that's the number of transactions. This is shares outstanding multiplied by the value of the price of the shares. So the higher the ratio, the more liquid the market is, and the easier the trading, and the less price concession that you have to give up if you have to quickly trade the stock. And why is this attractive? If you are the investor, you want to generate a profit from holding onto a stock, right? And if you have to give huge price concessions, then you are not going to trade in the stock market, you are not going to trade in the stock. And from the stock exchanges, from the firm's perspective, if the market is very illiquid, then it's not going to attract a lot of investors, right? It's not going to attract a lot of investors, then why does it want to go onto the market? It's pointless because they are trying to reach more capital and larger investor base. Other measures include trading volume, return volatility, bid-ask spread, and so on. And also volatility of the prices. If we're looking at volatility of the prices as a measure of the stock market liquidity, do we want more smooth volatility or do we want more jumpy volatility? So if we're using return volatility to measure liquidity, do we want liquidity that are mapped in this way, or do we want liquidity that are mapped in this way? Smooth or jumpy? Smooth, right? Because if it is smooth, that means the market is very liquid. You're not taking on big price differences. Whereas if it is very jumpy, very discrete, then there are a lot of differences in the prices, huge differences. So we want more continuous price movements in the liquid markets. Equity markets in the developed worlds tend to be much more liquid than emerging markets. Right? So this is the liquidity factor of countries around the world. So this maps the turnover ratio by nation. The turnover ratio, remember, the bigger, the better. So which are the countries with the highest turnover ratio? US? China? And Brazil, right? Right, so basically you see that Canada is the next one that's pretty good. You also see one that's sort of masked here, which I think is the German Börse. And then obviously United Kingdom is also sort of masked here. It's also very liquid. Cross-listing. Well, cross-listing, this gives you a distribution of which stock exchanges attract more foreign listing. So looking at all of this, the dark blue ones are the foreign listing, which are the more popular stock exchanges for foreign companies to cross-list. NYSE Euronext, definitely. London, NASDAQ, NYSE Euronext in Europe. So that's because NYSE has also merged with Euronext. So we have a giant group where NYSE and Euronext, all of the major markets in Europe, they're under the same company. Deutsche Börse, Australian Stock Exchange, pretty popular. Singapore Stock Exchange, Mexican Stock Exchange, pretty popular as well. TMX, which is the Toronto Stock Exchange, merged with Montreal Stock Exchange. So, why do you think that the New York Stock Exchange or the London Stock Exchange are the more popular ones, other than liquidity? So liquidity is one of the factors that we talk about. The second factor is value add. What kind of value add would these popular stock exchanges offer to their foreign listers? Pardon? Large capital base, yes. So you have a wide investor base to reach out to. Yes, so you have a certification effect or a branding effect. Because in order to list on these markets, you are under pretty tight regulatory scrutiny. You have to file, you have to prepare due diligence, you have to do a lot of information reporting, right? So if you are able to list on these sophisticated markets, this sends a positive image to your investors, to your customers, that you are a company of certain status, right? So this gives you a certification or branding effect. Any others? Those are already very good. So other ones that you might think about if you are a foreign company to list on those areas include also plenty of skilled people, because they are already really big markets. This is where all the talents are concentrated. Wall Street, right? London, Canary Wharf. It's where all the best and brightest in the market are concentrated. So you would expect that they are able to, again, have the skills spill over. The location, good infrastructure. If they're established, they are already very mature, so you are certain that everything will run off very well. So hopefully, by 2 semesters, taking classes and lectures in this lecture hall is going to be a dream. But right now, it's being established. So that's why you have to bear with all these technical problems, right? So this is a very good example as to when the infrastructure is being just put into place, there are lots of problems that you have to deal with patience, but hopefully this is going to be worth it. But then once it's established, you are going to expect much less hiccup, right? So that's one really key point. Yeah, it's a really key point. If I put this in an exam, I'm going to put emphasis on this because of all the pain that we have suffered. It's also English-speaking environment because instead of having to learn, say, German or learn, say, Spanish and so on, English is the most spoken country in the world. It's just very easy to access to. So the London market and the New York markets are really popular. And we have the actively regulatory and tax environments for certification effects and so on. And branding, oops. And anyways, low levels of corruption. All right, so would you mind if you stay with me towards the end, or should I break here? That's why I'm debating right now. Who wouldn't mind staying for a few more minutes? Like 10 minutes? Yeah? Raise your hand. All right, I'm seeing more show of hands. Thank you. Okay. All right, so why would we go cross-listing? We have already talked about those, so let's summarize them here. So broaden the shareholder base to more markets, increase the firm's visibility and acceptance. We talked about that. Price discovery, improve the liquidity of your shares and support a liquid secondary market. If you want to acquire other firms in your host market, this is a very good way to get into the market and make yourself known, right? So if the local market that you're trying to expand into with mergers and acquisitions, if you are already present on the foreign markets, people know you, then it's much easier for them to accept you. And also, if you have existing equity on the foreign market, then the deal can be done with just an equity swap rather than paying out by cash, right? You're just giving your equity to the bought-up company. So that's very useful. And if you have subsidiaries in the foreign market, you can compensate the local management and employees with stock options. In the local market. So this is a very good way to incentivize their performance in the local market. Okay, price discovery and better issue price. Why is this a factor or a benefit that comes with issuing in a foreign market? What do we mean by price discovery? Price discovery means that there's probably a fundamental share value for the equity, but right now it's not where it should be, right? So you have a fair market value that is based on the present value of future expected cash flows. So it is somewhere up here. Right now, it's somewhere down here. Price discovery means that over time, you're going to reach the fair market value. Why would listing on a foreign market help you with price discovery? Or to be able to get a better price? Definitely. Very good. So the idea is that if you are on a sophisticated stock exchange, then you are going to have more analysts and equity research analysts to cover your stock, right? Why is the stock price not at its fair market value right now? Information asymmetry. There's not enough information about your value. So by going to a foreign market and listing on the foreign market, you get expertise from those foreign markets to discover your value, to discover information, to generate information about your company, to make you more visible, right? So that is how going on to foreign markets would really help, if everything goes right, to generate value. So you're going to improve on information asymmetry with equity research expertise. What else? You could also expand your future expected cash flow by going international. So this is working on this part. You can expand this by increasing your visibility to other market participants. So you're going to be able to expand visibility. Why is that good? That's going to increase your business potentials and increase your business revenue, right? And if you're able to increase that, that is going to improve on your stock price. So one is information discovery. The other one is more of a growth aspect. So those are some of the things that you associate with going to other markets, and especially going to international, to more sophisticated markets. So this, again, I would say is more important for cross-listing on more sophisticated markets. Very good. Again, cost doesn't come for cheap. Benefits doesn't come for cheap. So you have extra issuance costs, extra recurrence to the issuer, and potential trading costs, and also potential trading impact. Extra recurrence here, if you are listed on a more sophisticated market, you have to perform regular reporting, legal fees, right? Information preparation, basically, you have to be prepared to do all of the administrative resources, to devote all of the administrative resources to be more transparent. On the downside, if things don't go well, it's going to have a price impact. That means you could suffer a drop in price. In what cases would you think this could happen? And it has happened. You are a company, say in country A, you went public in the US. You started out doing pretty well, but then sometime later, your price tanked on the New York Stock Exchange. Why do you think that might be the case? Initially, it could be that initially your stock price could be overpriced. And if that's overpriced, that means there is a certain form of information asymmetry, right? So again, this ties back into the price discovery process, right? Price discovery could be improvement in your stock price. Price discovery could be doing bad on your stock price. As more people know about the information of your company, they can find better potentials, or they can find potential really bad problems, right? So if you are going international, you have to be prepared that everything is really waterproof. You are not concerned on scrutiny, right? Because with additional research, bad things about you can happen. So if you are a company that has some questionable things or behavior or anything that's hidden in your balance sheet, you would be more likely to be found out. Problems can be found out. So price discovery works in both ways. All right. Just so I have you right now, all right, very good. So just so I have you right now, let's go quickly into the next very interesting example of the case of cross-border IPOs, right? So with cross-border IPOs, especially in the case of China, they are the leaders and the predominant players in the cross-border IPOs since 2010. So since 2010, there has been 33 initial public offerings with Chinese companies being listed on the New York Stock Exchange. So they are a subset of the cross-listing because cross-border IPOs means that they don't actually have listings on their domestic market. Their first issuance is in a foreign market. So with Tencent, with Alibaba, and most recently with Luckin Coffee, they are all the companies that are headquartered in China, operating in China, but they did not have listing in China, but went directly for the NYSE or NASDAQ, right? So these are the companies that have done that. And so, oops. So in this case, the top 10 US IPOs of the last decade is, which is the biggest IPO? By looking at the size of the bubble, Alibaba, right? So the biggest IPO in the US history of the last decade is a Chinese company that went directly, that became directly listed on a foreign market. So why is that the case, right? It goes very much as why the other companies go foreign, but with the Chinese case, there are additional flavors. So the first idea is that there is a very difficult process to get listed on the Chinese stock market. It is notorious that if you want to get listed on the Chinese stock market, you have to jump through a lot of hoops. All right, so it's very difficult to get approval. They tend to approve companies with more mature business processes and revenue in the Chinese stock market before they give approval for them to get listed. And so for these technology companies, they tend to be younger and so on, and so they feel that they're not getting as good of a deal. And there's also a squeeze out by the national funding, where the funding goes to, because most of the bank loans in the local national market in China are given to the state-owned enterprises. And so that makes it a lot more difficult for fledgling technology companies to get funding. So they want to go overseas. And for those companies who want to go for shadow banking, taking loans from the offshore markets and so on, because there is tightening regulations, it also made them much more reluctant to engage in the market. And so they want to go overseas. And this is in addition to all of the things that we have talked about before, in addition to all the points we've covered before, right? So that's the case. A curious point here, Alibaba initially negotiated to have their listing on the Hong Kong Stock Exchange. But they eventually went with the NYSE. Why is that the case? It's about the value add from the stock exchange. They wanted a specific feature. Yes? That's definitely it. Increasing, by going on to the New York Stock Exchange, they increase more global awareness of the Alibaba brand rather than just to list on the Hong Kong Stock Exchange. Yes?
I think also the early investors probably are very global, so they want Alibaba to be in the global stock exchange so they can catch up.
Okay, so another consideration is that the early investors in Alibaba tend to be more global companies. And so they want Alibaba to go to the NYSE so they can cash out and have more liquidity and more control on the issuance. Those are definitely key factors.
Because I did remember the global investors told Alibaba that for every single product Taobao sells as counterfeit that's exported out of China is $1,500 fine on Alibaba. That's the agreement Alibaba had with its global investors before IPO.
Right. So what Jim said is that the global investors agreed with Alibaba that, Alibaba performs this trading platform called Taobao, right? So the global investors had a deal with Alibaba that for every counterfeit product or fake product that Alibaba sells on Taobao, there is a heavy fine for each item. So this is additional control and monitoring that they can get on the New York Stock Exchange. Definitely, so for all of those things, plus one that Facebook got on the NYSE. and that Hong Kong Stock Exchange did not want to give to Alibaba, which are the equity. So basically, on the Hong Kong Stock Exchange, they insisted on every single share issue has the same voting right. But on the New York Stock Exchange, and what Facebook got is that the founding partners was able to get shares with more voting rights. Right? So Alibaba cared about the voting rights, and in addition to the global recognition, to the global monitoring, so they eventually went with New York Stock Exchange. So the Hong Kong Stock Exchange was very sorry that they lost Alibaba, and they started to review their rules on whether or not every single share should have equal voting rights. But that's outstanding right now. So these are all the interesting and additional features that you would have to think about choosing the markets that you go to. So these are some of the statistics on cross-border IPOs over time. So top countries of origin are Singapore, Greater China, Malaysia, and top IPO destinations so far are Hong Kong, NASDAQ, Sweden, and Singapore. So that's for the trend for 2019. How do we cross-list? Well, most often, cross-listed stocks can be traded directly on a national stock market just as a common share. And other times, especially in the case of the Chinese IPOs, they are traded in the form of depository receipts. So they're called DRs. And there's going to be an extension in the next topic, but that pretty much sums up the international bond market and the equity market. And thank you very much for your patience with the glitch and with staying over time. I really appreciate it. Everything is recorded. I extended the capture, so don't worry about that. And I'm going to get back to you as to whether I can schedule another class or I'm going to record everything in my office and see what happens. Thank you. Have a good night.